Imagine planting a tree today and coming back 30 years later to find a forest. That's exactly how long-term investing works. Most people believe building wealth requires predicting the next Apple, Nvidia, or Tesla. In reality, the biggest fortunes are often built by people who keep investing simple. The problem is that many investors own several different funds without knowing what's actually inside them. They assume more funds mean better diversification, but often those funds hold the same companies again and again. Instead of reducing risk, they're simply paying extra fees for duplicate investments. In this video, we'll break down a simple 3-fund portfolio that has stood the test of time. And we'll also look at the first building block is a total U.S. stock market index fund. Rather than buying a handful of companies, this type of fund owns thousands of publicly traded American businesses. Large companies, mid-sized businesses, and smaller growing firms are all included in one investment. As the economy changes, the fund automatically adjusts. When new companies become larger, they naturally become a bigger part of the portfolio. When companies decline, their weight becomes smaller. The biggest advantage is simplicity. You don't have to guess which industry will dominate over the next decade because you're investing in the entire U.S. economy. The second building block is an international stock index fund. Many investors invest only in their home country because that's what feels familiar. But the global economy extends far beyond one nation.
International funds give you ownership in companies across Europe, Asia, Australia, and many other developed markets. Different countries go through different economic cycles, so international investments can help reduce dependence on a single market. No one knows which country will lead the next decade of growth. Diversification simply prepares you for whichever region performs best. The third building block is a broad bond market index fund. Bonds rarely make headlines because they usually don't produce explosive returns. Their purpose is different. When stock markets become extremely volatile, bonds often help reduce overall portfolio swings. This stability becomes especially valuable during major market downturns. The right bond allocation depends on your age, financial goals, and comfort with risk. Younger investors often hold fewer bonds, while investors nearing retirement usually prefer a larger bond allocation to help protect their savings. Together, these 3 funds create a diversified portfolio that requires very little maintenance. Instead of constantly chasing new opportunities, investors can focus on contributing consistently and letting compounding work over time. Now let's discuss 7 types of funds that deserve careful consideration before investing. First are high-fee actively managed funds. Some managers consistently outperform for short periods, but maintaining that advantage over decades has proven extremely difficult. Higher fees may seem small every year, but over long investment periods they can significantly reduce your ending wealth. Second are expensive target date retirement funds. These funds can be excellent for investors who want complete automation. However, some versions carry higher expense ratios than necessary. Before investing, compare costs and understand how the fund gradually shifts toward more conservative investments. Third are leveraged ETFs. These products are designed primarily for short-term trading. Because they reset daily, their long-term performance may differ dramatically from what many investors expect. Fourth are theme-based ETFs. Whether it's artificial intelligence, robotics, blockchain, clean energy, or another popular trend, these funds often become available only after excitement has already pushed prices much higher.
That doesn't automatically make them bad investments, but popularity alone shouldn't be the reason to buy them. Fifth are single-country investment funds. Investing heavily in just one country's stock market increases exposure to political events, currency movements, and local economic challenges. Broader international diversification generally spreads those risks across many countries. Sixth are overly specialized dividend funds. Dividend-paying companies can absolutely play an important role in many portfolios. However, focusing only on dividends may unintentionally reduce exposure to fast-growing companies that reinvest profits instead of paying dividends. For many long-term investors, total return matters more than dividend yield alone. Finally, be cautious of any investment that is marketed as a guaranteed shortcut to wealth. Successful investing is usually slow, disciplined, and sometimes even boring. Products promising extraordinary returns with little risk deserve careful research before investing. So what does a simple long-term portfolio look like? Many investors choose a broad U.S. stock market fund, an international stock fund, and a broad bond fund. They contribute regularly, rebalance occasionally, keep investment costs low, and avoid reacting emotionally during market volatility. Over decades, consistency often becomes far more important than finding the perfect investment. One additional concept worth understanding is asset location. Some investments may be more tax efficient in certain account types than others. Learning how different investments are taxed can improve long-term results without increasing investment risk. The most important lesson is this: building wealth isn't about owning dozens of complicated investments. It's about owning a diversified portfolio, minimizing unnecessary costs, staying invested through market ups and downs, and allowing compound growth enough time to work. Markets will rise, markets will fall, headlines will change every week. But disciplined investors who stay focused on long-term investing have historically given themselves one of the best chances to build lasting wealth. Remember, successful investing isn't about being the smartest person in the market. It's about making smart decisions consistently for a very long time.